This is an analysis from Alpha Business Media. Okay, so let's dive right in. For years, the whole world of sustainable finance has been buzzing about this one very appealing idea, the Greenium.
Right, the Greeniums. It was this beautiful promise, really.
The ultimate reward for doing good, financially speaking. If you issued a bond for an eco-friendly project, say a geothermal plant,
Or even sustainable housing.
investors would actually accept a slightly lower interest rate.
And that tiny difference, maybe a quarter of a percentage point, that was the Greenium. For a big bond issue, we're talking millions of dollars in savings. It was meant to be this huge incentive, the financial lubricant, to speed up the green transition.
And what the analysis we're looking at today shows is that that whole era, that expectation of easy, cheap, virtuous capital, it's over.
It's decisively over. The Greenium is fading, and it's fading fast, globally.
And this isn't some far-off tremor in London or New York. This shift completely redefines the game for developing nations.
Exactly. For a country like Nepal, which has these immense needs in clean energy and climate resilience, their entire development plan hinges on getting this kind of capital. So our mission today is to really get into the strategy for securing that finance in this new post-Greenium world.
And the sources are crystal clear on this point. That price advantage, it was never a subsidy, right? It wasn't a permanent entitlement.
No, not at all. It was a temporary reward for the first movers, the early adopters.
And now we're seeing this collision. On one side, you have this massive hunger from governments and corporations for cheap ESG money.
And on the other, a huge wall of investor skepticism that's been building for years because of greenwashing.
So what's so interesting here is how the market is maturing. The Greenium isn't just gone, it's selective.
It's vanishing for vague promises.
Right.
It's now only being reserved for issuers, countries, banks, whoever who can provide audited, granular, verifiable proof of their impact.
If you can't prove it with hard data, you don't get the discount. Simple as that.
You're just another borrower.
Okay, so let's get into the mechanics here. Why is this happening now? The analysis points to two main causes, and the first one is just simple market saturation.
Yeah, the anatomy of the fade has two parts. The first is pure supply and demand. If you think back, 5-6 years ago, credible green bonds were really scarce.
Right.
But the demand was just exploding. You had institutional investors getting pressure from everyone, clients, regulators, to hit these ESG mandates.
So a huge pool of money chasing a very small pool of assets.
Precisely. And that imbalance just bid up the price of those bonds, which pushed down their yield compared to normal bonds. And that gap, that was your premium. It was a novelty premium in a way.
But then everyone else saw how much cheaper the capital was and wanted in on the action.
Correct. And the analysis says the market is now, and I'm quoting here, awash with green issuances. It went from niche to mainstream almost overnight.
So you have tech giants issuing bonds for green offices, fast fashion companies, for sustainable supply chains.
Everyone. And when you have that much supply, and a lot of it isn't exactly high quality, that novelty premium just dissolves. The prices converge.
And that puts new entrants in a really tough spot.
It's a huge challenge. If you're Nepal or any emerging economy just now, setting up your green finance rules like the CBAN guidelines, you're basically arriving at a party just as the lights are coming on.
Oof, that's brutal timing. The global market isn't running on that early excitement anymore. You can't just label something green and expect a discount.
No way. Global investors are benchmarking your bond against thousands of others. The label is everywhere, so it's become meaningless without real substance behind it.
Which brings us to the second, and I think more important, cause. If saturation shrunk the Greenium, it's investor skepticism that's forcing the market to demand quality.
That's the critical link. That skepticism comes directly from years of being burned by greenwashing.
Right.
But the sources reframe this in a brilliant way. They say this isn't a market failure. It's the financial market's immune system finally activating.
It's purging the low-quality assets. It's forcing a flight to quality.
Exactly. This intolerance for vague language, for promises of general corporate green purposes, it's a hard veto now. Investors are the ones enforcing the authenticity.
Okay, that makes sense conceptually. But let's talk about what that looks like on the ground. The skeptic's veto, this demand for proof. How are investors actually doing this?
This is the new operational reality. They're not just relying on those easily gamed third-party ESG ratings anymore.
So what are they doing?
They're building their own in-house teams. We're talking climate scientists, data specialists, geotechnical analysts. Their due diligence now has real teeth.
I have to stop you there. If big investors are hiring their own climate scientists just to vet a bond, doesn't that make it almost impossibly expensive for, say, a first-time Nepali hydropower company to even play in this game?
That's a really important question.
The cost of just collecting that data might wipe out any potential savings from the Greenium itself.
And the answer is yes. The upfront investment in that transparency is high. But the argument in the analysis is that it's a non-negotiable cost of entry now. If you fail to invest in that verification today, you will be completely shut out from high-quality capital tomorrow.
So not having the data is seen as a major risk factor in itself.
A huge one. The market sees it as deliberate obfuscation, not just a minor oversight.
So give us some of these punishingly specific questions that investors are asking. What are some examples?
Okay, let's use the example of a cement kiln. A Nepali company issues a green bond to upgrade its kiln for cleaner production.
Right.
The investor doesn't just check if the money was spent. They demand to know the exact percentage reduction of specific emissions, your knuckacks, your SOx, particulate matter. They want the baseline data from before the upgrade, the tech used, and a legally binding promise for quarterly audited reporting on those numbers.
Wow. That's a jump from an accounting check to an engineering mandate.
It is. Or take an ecotourism project, maybe near the Annapurnas. Investors are checking satellite imagery to make sure there's no encroachment on protected land.
They're doing their own surveillance.
Proactively. They're scanning local social media for signs of community conflict. They're demanding detailed, auditable plans for waste and water usage. If that granular data isn't there, they just walk away. It signals too much risk.
So the company's need for cheap, flexible capital is now in direct conflict with the investor's need for hard, verifiable proof.
And that's why strategic positioning is everything. And this is where we can look at the neighborhood, at India and Bhutan for two very different playbooks.
The scale strategy versus the brain strategy.
Exactly. India went for massive volume. It became one of the biggest emerging market issuers, which created a ton of liquidity, a sprint for size. But that scale often meant quality verification was inconsistent. Scrutiny started to build around whether the funds were truly additional.
And explain that term, additionality.
Additionality is key. It means the money has to fund new projects that wouldn't have happened otherwise. If you're just using it to refinance an old loan for a solar project that's already built, you're not creating any additional environmental benefit.
Right.
And India's volume led to questions around that, which diluted trust and, in turn, eroded the greenium within its own market.
So the lesson for Nepal is, don't even try to compete on volume. It's a race you can't win.
Absolutely not. And the alternative is Bhutan. Bhutan hasn't even issued a major green bond, but it shows the power of an unimpeachable sovereign brand.
Their constitutional mandate for 60% forest cover, their carbon negative status.
These are hard, verifiable facts baked into their national identity. That credibility just crushes issuer risk. If Bhutan issued a bond tomorrow, investors would likely pay a significant premium because the country itself is the proof. They built the trust infrastructure before they even thought about the bond.
And that's Nepal's opening. It doesn't have India's scale, but it has the raw materials for a Bhutan-like brand. The Himalayas, that incredible hydropower potential.
Regenerative tourism.
So the strategy isn't to be the biggest market, but to create a boutique market, to be the most trusted market, specializing in these high-integrity, transparently audited impact bonds.
That is the core takeaway. It's about embracing this new reality of verification.
Which brings us to what's next, the great fracture.
Yeah.
It seems like the old single green bond concept is officially splitting in two.
It's bifurcating, yes. This is how investors are going to filter everything from now on. On one side, you have your green labeled bonds,
Legacy assets.
the legacy assets. Vague language, financing general corporate activities, no real granular reporting.
And the outcome for those.
Zero greenium. They'll be treated like any other corporate bond, but with the added risk of being called out for greenwashing. The effort to even structure them won't be worth it.
And then there's the successor, the impact verified bonds. This is where the premium has moved.
This is it. These are valued on data, not a label. They require a legally binding covenant to report on specific, audited, engineering-level metrics. This is the only game in town for cheap, sustainable capital now.
Let's get specific on that data. For a Nepali hydropower project, what kind of metrics are we talking about?
Okay. For a run-of-the-river project, you have to report way beyond just revenue. You have to publicly report megawatt hours of clean energy produced, sure, but also the tons of CO2 displaced from the grid relative to the existing fossil fuel mix.
That's very specific.
And critically, operational data like sediment flow to prove you're managing the downstream ecology.
And the analysis says technology is the key to proving all this.
Absolutely. The cutting edge is using things like public ledgers or blockchain to track the money from issuance all the way to project completion and then to the operational data feeds. It creates an unbreakable chain of custody for every dollar and every claim.
So the conclusion is powerful. The Greenium isn't dead, it's just going to survive, maybe even get bigger, but only for these impact-verified bonds. Investors are paying for certainty.
They are fleeing ambiguity. The premium has migrated from good intentions to verifiable proof. It's a fee for transparency.
So what does this mean for Nepal's action plan? We know the goal is to be the most trusted, not the biggest. What's the hard truth about the next steps?
The hard truth is that this isn't about clever financial engineering anymore. It's about building a national verification infrastructure. You can't monetize trust until you can audit it.
So action item 1 has to be regulatory. What does 7 need to do?
Right now, the focus is just on use of proceeds. Did the money go where you said it would? 7 needs to elevate its guidelines to mandate independent, recurring, and fully public audits of the complex impact metrics we've been talking about.
Shifting the focus from accounting to engineering.
Exactly. And second is capacity building. You can't just keep hiring expensive foreign consultants to do this technical work.
Right, you have to build that expertise at home.
Nepal has to build its own domestic MRV monitoring, reporting, and verification capacity. It's about empowering local engineering firms, universities, environmental agencies to become those trusted auditors. It keeps capital in the country and builds sovereign credibility.
That's a long-term play, not a quick fix. And finally, the tech leap.
Establishing a national registry for these projects, using digital tools to give investors real-time data feeds. Imagine an investor logging into a portal and seeing verified, immutable data from the hydro project they funded. That turns Nepal from a follower into a global leader in transparency.
You know, this entire deep dive has really shifted my view. The premium on green finance isn't gone at all. It's migrated. It's no longer a reward for good intentions. It's a fee you earn for providing verifiable proof.
And for a nation like Nepal, where the economy and the environment are so deeply connected, this is the clearest opportunity they've ever had to monetize their commitment to a sustainable future. The cost of doing business is now simply the cost of being honest and auditable.
Which leaves us with a final provocative thought for you to think about. If transparency is now the main currency for sheep capital, what traditional sectors in your own economy, or even in your own investment portfolio, are still operating on vague promises? And how quickly will they be forced to adopt this kind of blockchain-level verification just to stay competitive? Something to consider as we all navigate this new era of finance.